All right, family, I'm back with you. Another one. Just want to make sure you understand that if you hadn't fully understand the first video, go back and watch it. It's important because we're now taking the next step. Again, if you receive any of the benefits from your father, to my kids, to my nieces and nephews, if you receive it, this is the next aspect on the journey. And again, this video will be in antiquity, so you have access to it. But it's important that you start learning this now. I think sometimes, which is totally inappropriate, is that we wait way too long in order to educate our kids on things is the most important thing they should know in advance. So let's jump right into it. I'm going to share my screen. I'm not going to, hold anything back and jump right into this here. Okay, so what I did was I sat down and I want to tell you these are real numbers that are correlated with one of my client's friends' sons. So got signed off everything, but this is his net income at the end of the day. So his dad and I were sitting down, we were going over it, and his friend came over and he said, could you help my son with his company taxes? And he has an LLC. And one of the things is whenever I'm sitting in and since this is, it really, I'm visiting, I'm having fun, but at the same time, I wanted to make sure that as I'm listening, I'm also providing education. This is one of my close associates, so I'm not going to be there, not provide some guidance if I'm asked a question in this regards. And because I run C corporations, it's important for me to make sure that I'm always on my P's and Q's, being challenged, using critical thinking. The one thing that most people don't want to teach people is critical thinking, and critical thinking is important. We have to be able to do this at all times without hesitation. So let's jump right into it. So I'm going to list a couple of things. And as I list a couple of things, let me start off with this. If you go to the state where you live at and you file for an LLC or you file for a C corporation, you cannot go to the state where you live at and file for S Corp. A subchapter S is form 2553. That only comes from the IRS. That is a tax form. You are changing the way that you tax. A limited liability company, which was approved in all 50 states in 1988. Originally, the first state it was created in was Wyoming. A little bit earlier than 1988, but then just to understand, it was created to be a holding company. That was the original purpose. It was to be a subsidiary of a C Corp. Now, just as we all know, a lot of these things that you can do as time goes on, but let's just be very clear about this. This was supposed to be a C Corp subsidiary. So let's be clear. And you'll notice that I put down here the original design for this for a single person. No, it can be used by one, but a C corporation, no. A C corporation was never intended for one person. Neither was an LLC, neither was a subchapter S. So a subchapter S is actually a 2553 that you can attach to a limited liability or to a C Corp or to a limited liability partnership, which is a professional limited liability professional LLC basically. So was it originally for one person? No, just be very clear about that. I'll even highlight this area because this helps us understand. It was never designed for that. It was designed to hold as a subsidiary to a corporation, but it was not intended to be operated as a pass. How do we know this? Let's go back to some of the historical things that an LLC would do. As you know with me, I'm always going to go back to some historical. How do we know that it was never designed to be operated in the way that people operate it today? Here it is. Self-employment tax of 15.3. Yes. Self-employment tax, no. W-2 payrolls for stakeholders, no. Payroll tax deduction, no. See, this was never intended to pay payroll out of. This was never intended for the member managers to be able to receive a W-2. This is the reason that this is attached to it. The IRS allows a form called 2553 Subchapter S, which actually a limited liability company has as many members that it wants in it. Whether they're a company, trust, they can have as many members as they have in it to have access to that, whatever item is holding. Unfortunately, people are now using this as they would use the first legal entity that was ever created and been used before America was founded is a C Corp, just so we're very clear. Now, let's kind of go through the tail of the tape so you can see. Again, self-employment tax, yes. No W-2s for an LLC, no payroll. Self-employment tax, no. W-2 for stakeholders, yes. Payroll tax deductions, yes. Double taxation. The LLC is not double taxed. The C corporation is only if it pays out dividends. If it pays out dividends to its stockholders, the answer is yes, it's going to be double taxed. It's going to be taxed on a corporate level and be taxed on the shareholders level as well. But in this situation here, if you just starting, most likely you're not paying out any dividends because you can actually pay out a capital return, which is a return of capital, because stakeholders in a C corporation actually lend the company money. They lend it and it's owed back to that individual. So that's where the capital return comes into play, and that is not a taxable event. The LLC doesn't allow that. It doesn't allow you to lend money to your company. And the reason for that, because it's a flow-through entity, which means that the taxes pass on down to you, and you could take losses or you can pay the taxes on the gains. Well, however, a C corporation is not a flow-through entity, which means like a straw, you're holding a cup, you put a straw in it, you suck the juice out of it. A C corporation is, that straw is never going in that cup for a C corporation. It got a lid on it and you can't get anything out that cup. It's sealed. How come? It's just a separate legal entity. It pays its own taxes as you create it. So you see me sitting here, you might as well make another one of me sitting here, and that person came out of me, and except it's not me. It has nothing to do with me other than the fact that I can tell it what to do. But however, when it comes to consequences, we're totally separate. So it has, again, the LLC has protection on the level of, if you got in trouble, it has corporate protection. However, there's a lot of tax benefits you just straight up lose if you use a LLC. Now, the next thing, does the limited liability company underneath the new rules receive standard deduction for tax breaks? Yes. However, you can't own a house, you can't own land, because you can't be paying any taxes on property or paying any mortgages. If you do, you lose the standard deduction. So another thing for the limited liability company is that if you own a house, unless you want to go to jail for illegally, you get audited, you're gonna get caught. I've already seen that happen before, where people, they own their house and they use the standard deduction. Once they get audited, they normally get in trouble. And you know, it is what it is, because you should know better, because if you cannot own a house or you can't own land, if you're going to take the standard deduction, and you have to know that. You can't say, well, my accountant did it. No, look at the rule. Your accountant works for you. They're your employee. You're not their employee. They're your employee. So you can't own a house. You can't own land with that. But if you don't, and you're a renter for the rest of your life, or you live with your parents in the basement, then yes, you could take a $12,550. Again, can you take the standard deduction with the C corporation? No. Do you get the, you also have QBI, which is a qualified business income. The limit liability underneath the new rules, you qualify for that. That's 20%. So if you start off at $100,000 and we take 20% off of that, the net income is now at 80. If that's all you get, well, if that's the case, we're gonna go tell the tapes. We'll go over here in a second. Next, as we talked about before, these were not created for one person. Neither one of these was supposed to be for one person. Okay, can you carry forward losses or gains? With an LLC, no. Can you do it with a C corporation? Yes. There is no carry forward, and every year you must take the hit, the losses or the gains, just to be very forward. Now you say, what do you mean carry forward losses or gains? Well, most likely on your personal taxes, if you put money into the company, right, you can carry gains forward with a C Corp. You can't do that with this. A LLC has to run on a calendar year from January to December. A C corporation can carry forward losses and gains. How do you say that? Well, because what ends up happening, because on a corporate level, now on a personal level, you may have losses because you put money into the LLC and you may be deducting that on your personal taxes as a loss. However, we're talking about carrying forward losses that you didn't claim now, you know, and we mean that you can use them in another year. You only have those 7 years on that LLC. So with that being said, you can, because a C corporation can run from March to March. So you can actually carry forward and you can also go backwards. That's the one thing. You cannot go backwards with an LLC. You can carry forward or you can go backwards on it as far as taking losses in 2 different years. Okay? You cannot do that with an LLC, but you can do that with a C Corp. Deducting 100% of medical premiums, no for an LLC, yes for a C Corp. Deducting 100% of other friends' benefits. Friends' benefits classify not just the owners get, but your staff get, your employees. So every employee has access to the medical benefit plan program and for friends' benefits. Whatever those friends' benefits is, guess what? The LLC, no. C Corporation, yes. Write off 10% of net income to charitable contributions. With a LLC, no. That means that if we have $100,000, you can't take 10,000 off. Give it to your own foundation or charity that you control. You can't do that with a limited liability company. Can you do that with a C Corp? Yes, this is the reason you see that Buffett gives to his relatives. And now you see Bill Gates, Microsoft was donating to his foundation. How come? Because you get to take 10% of your net earnings. You can max that out every year. You could do $50,000 and you can carry 10% this year. You can carry 10% next year as a deduction. You can keep going. That's what we're talking about, carrying forward these losses and do that. You can give them 50,000 and then carry it forward. But the most that you can write off this year is 10, and then 10 next year, 10 after that, 10, 10, 10. So till you use up that whole 50,000. Next, encouraging passive investing, which passive investing means that the longer you hold the stock, and LLCs don't have stock, so they can't do it. But if I hold the C Corporation stock for 10 or 15 years as an owner, the actual tax begins to get reduced. If you hold it from if long-term equity holding positions, you can get your taxes almost down to like anywhere between 2 to 5% down the road. So it encourages passive investing. However, you can't do it. Now, if you take your limited liability company and you do a Subchapter S 2553 form and you change the 1065 to a Subchapter X for taxes, there are certain things you can do, and I'm gonna go on that to a second, but you do lose a lot of things. One of the things I would tell you is that for a C Corp, you don't ever want to convert that to a Subchapter S because you lose 10 to 15 deductions that off the top when you do that. Second, once you do that, you actually convert it back to passing all your money. You lose the carry forward. You lose so many things because now what you're doing is you're giving yourself a K1 and you functioning like your partnership, like an LLC. If you do that with a C Corporation or an LLC, everybody inside that company, if you start off with one person, everybody inside the company has to be American citizens. You cannot be an alien, which is a non-American citizen, and be part of a limited liability company with a Subchapter S. You cannot do that with a C Corporation either when you convert it to a Subchapter S. And when you're like me, when you have family members that are residents of the US, but before that, they were not residents of the US. I have family members that live in El Salvador, and I have relatives that live, from El Salvador to Spain to Canada. They can invest into a C Corp, no problem. If I had a limited liability company, they could never do it. If I had a C Corp, I converted to an S Corp, they couldn't do it. Even though the currencies may be different, they can't do it. Only the C Corporation allow you to have residents, US citizens and non-US citizens in the investment as stakeholders and officers in a corporation. You cannot, can an LLC, as we talked about before, 401k funding by fourth division of banking, venture capitalists? The answer is no. You cannot do, you can have 401k funding by the fourth division of banking in a C Corporation, yes. In an S Corporation, no. How come? Because they put a limit. They really do put a limit. And within certain restrictions they're not gonna let you do is that you can create a 401k plan, but you can't receive funding from a 401k plan. Only the C Corporation can actually receive funding from a 401k. What is that really? It's a profit and distribution share. If you convert your C corporation and you have more than one classification of shares to a 2553 subchapter S, you can only have one share. You just disregarded any other classification you had. And that puts a lot of restrictions. That's some of those limitations. The most investors you can have in an S Corp, once you convert it using 2553 from the IRS form, that you have to file every year, just remember that as well. You have to file that form every year, which is, again, a limitation. Here's the other downside to it. You can only have 100 investors. You go from unlimited stakeholders and financiers of your stock to being limited to 100. And you better pick well, because you can't have more than 100. If you're in an S corporation that you converted a C Corp to an S for tax purposes, also understand this: the day you no longer work, you can't be a passive investor in an S Corp. Let me just keep it short. You can't be a passive investor in an S Corp. Passive investor means you don't do the day-to-day. So if I have a person, like a relative that live in a different country, wants to give me funds, be an officer, be on a Zoom call, they can't do it with a subchapter S attached to the C Corp. So you're destroying the C corporation and for what it was made for. The other thing you don't see here is that this is another thing that you would see that you can do. And that is this: file for S1, file an S1 to go public. You cannot do that with an LLC at all. You can do that with a C corporation, but not with an LLC. So if your idea was, I'm gonna go public one day and I want to be on the billionaire list, and just so you know, you can cancel that, because as soon as you file an LLC, that's never gonna happen. Just gonna be very honest with you. It's never going to happen. So if you think you're going to be able to go public with an LLC, the answer to that is absolutely not. It is one of the things that I tell people is, if your idea in your life for you to start a company is to one day, have a company listed like I have, and to participate in a traded company, unfortunately, you cannot do that at all with an LLC. Just doesn't allow you. So it's so important to understand that the entry into your dream plays a big role too. And most people are saying, well, I can always modify it. You cannot take an S corporation and file an S1 either. That's another limitation. S corporation cannot file an S1. How come? Because an S1 filing is unlimited stockholders. You cannot have unlimited stockholders when you have a LLC, or you have you can actually have unlimited with an LLC, but the LLC can't file an S1 filing. So as far as filing that, never going to happen. As far as having unlimited investors, you change it. As soon as you put that subchapter S on it, that 2553, you now limit it down to 100 people. So at one point you could have unlimited members in your LLC, and now you can't. So now that we can see certain differences, and this is not all the, so there's more deductions. I limit this for this example so I can actually kind of educate you guys, so you can actually see. I mean, just look at it overall. If you have the net income of 100,000, will you have to pay self-employment tax? As a LLC, yes. Was an LLC designed for W-2 or payroll deductions? No. Is it double tax? No. We look at the C Corp. No, you're never going to pay self-employment tax. You will have payroll deductions. You will have W-2s you give out. Yes, it's double taxed if you pay dividends. If you don't pay dividends, no, it's not double tax. You just have the corporation to pay its taxes, and that's it. Case in point, I always hear this argument. They say, well, if you have an LLC, or if you have a C Corp, you're going to be double taxed, because you're going to be taxed on the corporate level, and you'll be taxed on the personal level. Well, the corporation pays its own taxes, so it's its own individual. But even if I didn't, let's say I'm not an owner and I worked at a job that was a corporation, I got to pay my own personal taxes anyway. I got to file it. So, and where did the money come from my federal, state, and Social Security? It came from their business bank account. I mean, I always tell people say, well, I earned my money. Okay, well, how about the year before you started and this is your first day? How did you earn anything? Did they not give you a salary? How did you earn it? Exactly, it came from their bank account. So regardless of anything else, the payroll taxes are gonna be taken out of the company's bank account from the beginning. As again, standard deduction, you get that for the LLC because they're looking at you as a one-person entity. There's a standard deduction. If you're married, it goes, I believe, up to about 25,000, almost close to 26,000 that you can use as your standard deduction. Again, because this is looking at, and this was a provision put in this last text that we just previously had when they changed it from being 35 to 21. Now, with that being said, you get qualified business income, which is 20%. So you get these two deductions. You don't get it for the corporation. But now we start to switch, which I think is important. Was this originally designed for one person? No, neither one of these was. And see, that I think that is the most important thing to remember. A lot of our egos don't want to share. A lot of us think that I'm gonna start this company by myself. I'm gonna own my own company. Let me explain to you because of that. Watch these numbers because of that self-centeredness. You know, it's about making economic impact, and it's also about stimulating GDP. These legal entities are supposed to stimulate GDP, not stimulate you. So that's not your mindset. You're not starting a company. So if you inherit and you have it, understand that I'm constantly stirring up and assisting GDP growth in this country, gross domestic product. Next, you can't carry forward losses, and you also can't go back. So you can go 2 different years, you can do it. You got around the calendar year with the LLC. So no, you can't do it. But yes, with a C Corp. Deduct 100% of medical expenses. Yes, no for an LLC. Deduct 100% of fringe benefits. Yes, for a corporation. No for an LLC. Encourage passive investing and less on capital gains in the future. No for an LLC. Yes for a corporation. 401k funding by the 4th Division of Banking. No LLC. Yes, C Corp. Will be forced by the IRS to purchase more inventory of this. This is a unique thing. This term write-off, before we go to the numbers, the term write-off means this. It means that I'm going to find ways to reduce my net earning by buying stuff. Remember the toys. So the IRS is happy because you may say, well, I didn't have to pay the IRS. I now still hold my calculator. I got a brand new pair of glasses. And because I got these glasses, I'm in a better position, but I didn't have to pay those taxes. Let me explain something to you. What they want, what the IRS want, when they create these stimulus programs that run through the Senate and the House of Representatives and both parties, whether, you know, one vote or whatever, whenever they pass these stimulus programs, you need to understand what this means. It means they don't want to stimulate. So if they can get you to take that and you reduce it down where you negative or you only have like 5,000 left, you went out there and you bought a car, well, you helped a C corporation who sells cars meet GDP. So they're gonna say, okay, so you have now 5 cars. Okay, well, you went on all these vacations, like, oh, look everywhere I have. The IRS is gonna say this one thing. Okay, you stimulated a C corporation who meets GDP. So that cruise met GDP. So no problem. You know what the realization is? Because you helping them meet GDP. But here's what the IRS said. You don't got no cash. Remember, the goal is to keep cash. And then second, you can never go public with an LLC. You can never go public with an S corporation. They are prohibited to go public with these things, okay? They're prohibited, which means you can't do it. However, a C corporation can. C corporation can file an S1 to go public. Now let's go to the tail of the tape. Let's look at these. LLC versus a C corporation in taxes. Let's go. And let's look at some of the benefits on the right-hand side and some on the left-hand side. You got the standard deduction, which is $12,550 that comes off the $100,000 plus, okay? And this number here has been adjusted, but I didn't adjust it on there. So you're gonna actually have 100,000. So I can put this number in there for you guys so you can see it. Let me do it in real time. So you have 100,000. And you're gonna take out of that $1,255. This will give us 87. Okay, that 87, and we're gonna take that 87,450. Okay, so if we take that 87,450 minus this 20,000, that's going to put us, and it's a 20% deduction. Well, I don't know how maybe the 8,407. It's 20%. That number there is 20% times 0.20. Okay, so that was right. That's 17,490. So this is 20%. The qualified business income is 20%. There it is, 17,490. All right, that leaves us with 67,450 of net income. We're gonna take half of the, again, you're gonna have to pay your Social Security, which and your Medicaid, your FICA, which is 15.3. You only get to take a half of that off, that 15.3. The whole amount that you have to pay is $10,704. You only can take half of that and take that as a credit. So that leaves you with $62,152. Now we need to look at the federal taxes, because remember, you're going to get a K1. That K1, this K1 you're going to get here is a document for the owners. And remember, this is a pass-through device. This is pass-through. So what does that mean? It means that you're going to get hit on the taxes. The taxes pass all the way through you. It doesn't go to anybody else. It's going to reflect on your personal taxes, because this here for the LLC, the form would be a 1065. That's the federal form, and then you're going to have a K1 that's attached. That's going to show your ownership, but it passes down to you. With this $62,152 puts you in the 22% tax bracket. So what is that? Well, let's just go back here. We look here. If you make anywhere between 40,526 to 86,375, that's 22% tax bracket. So that's what you win. So let's take the numbers and put it there. We're going to take 62,150 minus 40,520 plus $4,664. How come? So where does this plus come from? Well, one of the cool things, they already did it. If you're in this bracket, you need to take 4,664 plus 22%. Just remember that. That's where it came from. Because you have the 10 percentile, you got the 12 percentile, and the 22, $4,664. You have to pay that plus 22% on that any amount above the $40,525. Well, we go back and we look at that. Tail of the tape. Here we go. We take that out. That leaves us with $21,626 after we deduct that times 22, and that's going to give us $5,298 plus the $4,664 federal tax rate that you're going to be stuck with. It's going to pass down to you is $9,421.72 plus the total self-employment tax. Even though you get a credit up here, you still got to pay $10,704. And then you got your state of Nebraska tax, which is $2,319 on this 62. When you run those together, your total taxes comes out to be $22,444.72, being an LLC. If you was to convert your LLC to a Subchapter S, your taxes, if we do the same thing here, and we just take in the same numbers in Subchapter S, you're going to be a total of $16,240. However, if you do this as a C Corp, look at the difference. $100,000, $35,000 salary, which is 100% deductible. That's a fringe benefit. You have payroll taxes, same thing, $35,000. We're just going to take the payroll taxes, $10,740 payroll taxes. Charity, your charity. Oh, you didn't know? Oh, yes, that's why most corporations have their own personal charities. How come? Because you could pay 10% of the total net earnings to your charity. Interesting. Then you can do what you want to do with this $10,000 in your family charity. Then you have a $1,800 medical benefit that's deductible, $12,550 contribute to a 401k contribution that is deductible. And you also have $18,326 that you can carry forward, or you can take losses for it, whichever you choose. Let's just say this is a carry for it. That's a deduction. That leaves us with $11,620. Okay, that's money left. None of this, all of this here is coming out of the company. These two numbers actually do not leave the company. It stays in, but this is an actual cost that went out the door. So when you talk about write-offs, these are write-offs here. But this was not spent money. This cash is still in cash. This cash is still in cash. This cash is still cash. This didn't turn into inventory, guys. You're not gonna go out here and say, oh, what can you do with this extra money? It's still in cash. Now, let's look at the factor of federal taxes. This is on an individual. So again, your $35,000 salary, not for the corporation. The corporation pays its own taxes. This is how it looks, 35,000. That puts you into that plus, you're gonna have to minus that $9,950 equals 3,000. Now you say, where did this come from? How do we figure this out? Let's go back to the tail of the tape. We go here and we look at it. That's that number right here. We're gonna take this $9,950 out. Then we know that times 12 plus $995. We go back, here we go. 35,000 minus $9,950. You're in a 12% tax bracket. That comes out to be $3,006 plus 995 federal taxes for me if I'm just by myself in this corporation, which I would never do, but just to kind of give an example, because the LLC is based on one, we're gonna base this on one as well. It's not designed for one person, neither is the LLC, but for the sake of the conversation and comparison, we need to do that. Again, this is the taxes personally that are being taken out here that I have to withhold from the employee federal taxes. That's $4,100 federally on a salary of $35,000. And on the state of Nebraska, that's $1,035 I need to withhold from the state of Nebraska for a single person. He's not married, $1,035 for a total of $5,036. Keep this in mind. Keep this in mind. Now, here's the cool part. Let's now look down at the tail of the tape. So which legal entity allows you to keep the dollars? An LLC, $22,985. Difference? Corporation, your tax bill is $2,440.20. How much if you're an LLC, you're going to pay $20,544.80 more. If you're an S Corp, your tax is going to be $16,248. What is the difference? You're going to pay $13,807.80 more than the 2,440 C Corporation. So the winner of the battle of what is the best entity to use, even if you are a one-member person, which neither one of these was designed for, is the C Corporation. Now, the reason is that people keep going into these LLCs or taking an LLC and filing a tax status of 2553. This is an exemption with the IRS to change the way that your taxes to a partnership. If you do that, let me just explain. You're going to have some limitations. At the same time of you doing that, the traditional corporation, which built everything you see in entire economic systems on it, the entire system, you got to remember your W-2s that you're getting right now from a job, that is based on the C Corporation rules. Your Social Security, your Medicaid, your Medicare, your state tax return was all based on a C Corp. So for whatever reason, people keep forgetting that if it's all based on these C corporations, in order for the economic and the GDP to grow, you have to accept that that's where the stimulus exemptions are going to come. I mean, how many S corporations and LLC does the president has in his cabinet when he's talking about creating tax incentives? I mean, I don't think anybody ever thought about that. That they are not asking people who have an LLC and an S corp come to the White House and sit down with me and tell me about GDP. That's because the mindset of those don't think about GDP. They think about themselves. So the only person they're going to have to come to the White House that's going to have these conversations are going to be a C Corp. Every now and then they'll bring in a small business to have a conversation, but it's not how to solve GDP. It's to use that small business as a proxy so that they say, hey, look, we are dealing with we have some small business here. But as of today, if we're going to make this a battle over what do I use, an LLC, convert my LLC to a subchapter S. And the reason you convert your LLC to a subchapter S is for payroll. Because you remember, we made economic decisions before we start these legal entities based on a W-2 check, based on a pay stub. So When you want to go apply for a car or you want to buy a house, give me your last 2 months of your pay stubs and your last 2 years of W-2s. Well, you go out there and you start an LLC and you a single member LLC, you don't even have pay stubs because it's not designed to have to even issue those. Now you can issue your employees, but as an owner, it doesn't offer you that. Owners who have, if you have equity in the LLC, you don't get on W-2. That's why you hear so many people say they do draws. A draw is nothing but a way to cipher money out like petty cash and say it's for the business, but really it's for you personally to live. This is the reason that you got so many people that's not separated. Remember, a legal entity was not created for third-party interest. So I'm not supposed to show my company's books and show my personal bank statements together because that means there's no separation. And that's the whole purpose of having corporate. This is when you see people say, man, start an LLC and go get yourself a company credit card for your company and you co-sign for it. Oh, you just you didn't separate yourself from the company. You now won because if you don't pay that bill for the company, it affects your personal credit. So now you pierce your corporate veil. You know, guys, here's the thing. Go back and watch the first video, okay? Go back and watch the first video. Go back and watch the first video that I sent. That first video that I sent will help you. I mean, it's going to help you. It's going to guide you. It's going to show you. And now come back and look at these numbers. Remember, the first video I sent you was called "There's a Reason You Don't Know This." Go back and watch it. I know it's an hour, but this is your father. This is your friend. This is your uncle telling you, go back and watch the video. Sit your behind down for an hour and absorb it. Second, come back and watch this video again and look at the numbers. Now, I'm gonna tell you one thing that is so important. If you inherit something I give you, then you also have to take in consideration, you got to do what I do. If you didn't inherit this and you want to go this way and you want to pay 22%, because again, you got to pay all these, you have to pay $22,444.72. It doesn't matter, okay, if you don't, you have to pay this. So this money, hey, these money you get credit for here, you get credit for this. So you can have basically, you have money left in your company, but you're gonna pay $22,000. You go to the C corporation, we already down at 11, but we already contributed to a 401k. That's 100% deductible. That's a friend's benefit. You got carrying forward gains or losses. That's 18,000. So we gonna bring that number down, but we carrying forward money. We carrying forward gains, and this gains is not spent. Now, so people say, well, if you have this extra money left, now we can look at that. We're adding another layer here. We talk about the difference between the LLC, and then we'll say this, for this way we can have a little bit of difference. Some people say, well, I did better because I converted to an S Corp. Yes, you would do better because you converted to an S Corp. So this is the difference in the S Corp. So we're gonna put a subchapter. So this is gonna be an S Corp here for using that subchapter form. We're gonna see that difference. And then we're gonna talk about this. So that's the difference between the LLC and the S Corp. So if we're gonna go do this, then we're gonna take the difference of the 20,000. Okay, so now we need to go with this. So you have 22,900. Well, let's just take this number here, grab my calculator. We're gonna take the 22,985 minus this 13,000, actually minus 16. So 22,985 minus the 16,248. And that comes out to be a total difference of 6,700. Oh, I wrote in the wrong box. That is hilarious. Let's do this number again. We're going to take this 22,985 minus 16,248. So we have that number being $6,737. Minimize this, bring it up here. $737. So that is a difference between paying. So this is your difference rate. Let's bring it here. And let's take this number. So that's what it looks like. So if you ask what's the difference between those two, I'm going to tell you that you're going to make out better with the S chapter being attached to the LLC, but you make out the best with the C corporation. And that's the reason it's always going to be that way. The C corporation was designed for more people to participate. And you got to remember, if everybody that works a job in America has a 401k, then you got to understand what's attached to it. The only legal entity that can receive 401k money to operate on. This is why people see Apple in their 401k. They see, well, I got Berkshire Hathaway in my 401k. Well, I have Tesla in my 401k. Well, what does that really mean? The money that came out your 401k for whoever's your 401k provider, they are buying shares of Tesla, shares of a C Corp are considered financing capital. So Tesla, Apple, Berkshire Hathaway can make economic impact by bringing something else in. By you basically stating that I don't want to receive funding from 401k. Everybody in America, what's the first thing? An IRA receives money to fund a C corporation's operations, and then they give you money back. Notice something here. You don't participate in that, so you don't get that stimulus. I keep trying to tell people, who do you think use 401k money? C Corps, not LLCs or Subchapter S's. Again, a Subchapter S is a provision with the IRS that turns it into a partnership. The problem with that is it can't only have 100 partners. So that's a limit right there. So Subchapter S can't even take that in because you have to have where you don't have those restrictions. And what happens if that 401k belongs to a person who is an alien? We call it illegal aliens. That's a violation. You can't have anybody who's foreign. It only be American citizens in it that can use a Subchapter S form. So if you're not an American citizen, then you can't even do a 2553. I don't care if it's a C Corp or LLC, and then you use that exemption on top of it to change the way your taxes are. So again, this is another one for you guys. I hope you enjoyed it. It is January the 1st still. Is 1 minute before January the 2nd. You probably see it up here, 1 minute. But I wanted to make sure you guys know that I love you and I'm going to teach you, even if you don't want me to. If not, don't say that your family member didn't try to educate you, because no one gave me this opportunity, but I'm giving you this opportunity. Good night, everyone.